This is the Daily Market Rundown live from the Tradelo trading floor. It's June the 30th. Some highlights from today's show. The big beautiful bull is set to push yields higher. Bitcoin is now ready for record high prices and the S&P 500 is set to trade sideways. Good day traders and welcome. Happy Monday. Hope you all had a good weekend. Let's get stuck straight into it. A number of things going on. Of course, I'm not going to go over the obvious. We do know there was quite a bit of news flow pretty late on Friday. And again, it's this continued back and forth. And it actually does make reading the newspapers particularly important because, you know, something gets said on a Friday afternoon and then it gets backtracked on a Saturday. So it's very, very important just to keep up to date with exactly where we are on things, whether it's tariffs, whether it's, you know, the big beautiful bill, whether it's Iran, the US, and Israel, Middle East concerns. The reality is that we're in a fast-paced environment. Now, with that in mind, I think one of the key things and one of the key talking points of the weekend was, of course, the big beautiful bill. We do know that the president wants to get that through ASAP ahead of the July 4th holiday, which of course is this weekend. Now, with that in mind, it's very important to stress that typically, traditionally, seasonality-wise, this week tends to be very, very quiet, to the point where it's very much expected we're going to get a lot of sideways trade. And we'll talk a little bit about some of the weekly charts because I think therein is the opportunity scope for this week. It's very much going to be, I don't want to say fade the markets, but trade within the ranges. I think that's the key theme for this week. Trade within the ranges. Don't expect fireworks. Don't expect any kind of fundamental drivers this week. Because what everyone wants to do is they want to get past the non-farm payrolls on Thursday and then take a long weekend. Okay, so that's the key for this week is you've got to really keep your powder dry. There will be work to do and we'll talk a little bit about that work. But let's talk a little bit about the big beautiful bill because the reality is that it seems like it's going to get past the Senate today. There is a vote today. They of course spent the weekend reading through the entire thing. And once it gets passed today, it will then get pushed back to the House, which of course is also Republican held. And then they are most likely to pass that bill. Of course, there will be some obstructions, as there always is, but the reality is that it seems as though this deal is going to make its way through to the president's desk ahead of the 4th of July. Now, what do we need to take away from this deal? Well, I think the first thing to note, of course, is the fact that you know, the CBO has come out now. Again, we know that the CBO came out initially and said that, roughly speaking, the original bill that was passed by the Republican House would add about 2.6 trillion to the deficit. They've now revised that higher. So basically what they've said is the way the Senate is going to pass this, in essence, it's going to raise the deficit by 3.3 trillion. So it just keeps going up. The key takeaway here is that the administration ultimately says that the CBA's way in which they calculate their cost methodology is wrong. It's not done correctly, and effectively the way the administration sees it is that the extension of the tax cuts from 2017 shouldn't be included in the calculation. And so that's how the administration seems to think that they've got a neutral budget, whereas the CBO sort of sees it as a sort of a 3.3 trillion addition to the deficit. So again, this doesn't really matter for us as traders. It's more interesting than anything else. The key takeaway is how the market's going to perceive this. Now, one thing I would say is coming into today, I perhaps expected yields to be pushing a little bit. I expected, the yields to be pushing a little bit higher over the course of the last 2-3 weeks as we moved into this vote. And yet the reality is that yields, if anything, are moving in the opposite direction. We'll talk a little bit about that in a minute when we get to the chart, but I think that's important to stress because, whilst of course we've been following this big beautiful bill for some time, it's not exactly new news. Okay? It's not exactly like we're all getting a surprise, 3.3 trillion, hey, surprise. The reality is that the market should have already priced this, and I think to a large degree, the equities have priced this. They've priced in this fiscal boost. The bonds, however, seemingly have also priced this, and so I think the fact that the bonds are not moving a great deal tells us a little bit about how the market thinks about this, which is perhaps we're going to need to see the impact of this in terms of inflation, in terms of actually what it does before we can start to push yields either higher or lower. Okay. We'll get to that chart in a minute, but I think that's the key takeaway, is that right now it doesn't seem like this is going to be a market-moving event. We will, of course, get this passed on to the Republicans in the House, and then that should get signed by the 4th of July. Now, moving on, of course, there's a tweet, and this kind of ties in quite nicely with the Big Beautiful Bill from Jim Bianco, definitely worth following. And it's this sort of idea that Besant's come out over the weekend. We know that Trump has again blasted Chairman Powell for not cutting rates, calling him a stupid person. But the key takeaway, I think, is we're getting an idea of what the administration's strategy is going to be, what Besant's going to do. They're in essence going to refinance at the front end of the curve. Again, not new. Janet Yellen did this already under the Democratic government. Of course, we know that Besant and, of course, many others said this was a horrible strategy. And in essence, they're just extending it. So they are effectively financing themselves in the front end of the curve. And so that means it'll mature sooner. And the general thinking is they'll extend the duration of that debt once rates start to come down. Okay, now, what does this mean? Well, the implications are, of course, that perhaps we will see quite a lot more demand in the front end. So we should see auctions go very, very well, particularly in the front end of the curve. But of course, we do need to see how investors look at the back end of the curve. Again, now, over the last 4 or 5 weeks, we haven't seen a single bad longer dated auction, and I think that's key to stress. The market doesn't seem too phased right now by the Big Beautiful Bill, doesn't seem too phased by the way in which the US government's financing itself. If anything, the long bond auctions have gone very, very, very well. Okay, so right now there's no investor fear, there's no real concern around this, but I think the key takeaway is that the general thinking of Trump is perhaps, it's not wrong, but it's perhaps flawed. He's leaning on Switzerland as a sort of a baseline as to, how can they get away with sub 1% yields when we are the biggest, best economy in the world. We should also have 1% long dated yields. And I think this is his general line of thinking, which is, if we cut interest rates, ultimately we can also have 1% yields. And that is true if you have inflation at 0% like Switzerland has. Okay, right now inflation is running inflation, if anything, somewhat disinflationary. They've got 0% inflation, and that's why they have such low yields. Now the US is a different kettle of fish, of course. We know inflation there is running just below 3%. So the key takeaway is, if you do want lower rates, you do need very stable, low inflation, and right now we just don't have that in the US. Now, what does this all mean? I'm going on and on and on, but what does this all mean? Well, what it means is even if Chairman Powell did cut by 1% today, the reality is that your long bond yield won't come down. Why? Well, because long bond yields need to price in growth and inflation expectations. Okay, so until the Fed gets inflation back to its target or perhaps even below its target, we are going to see these elevated yields in the back end. Now, let's get on to it. Let's have a little bit look at that chart, because something interesting is going on in the yields. The first thing to point out is you can see since 2023, we've been flat. Okay, let's call it what it is. That purple line, which is the 200-day moving average, is flat. Okay, if I was to narrow the line of focus to 2024, and I kind of start somewhere over there, you can see, I've done that horribly, but you can see effectively we have been inside a range of about 15 basis points in terms of the 200-day moving average. Okay, so it's whenever we extend on this band, it does come down relatively quickly. Whenever we extend to the downside, it does come back relatively quickly, and that's why we've got a flatlining of the 200-day moving average. Okay, it's stuck inside a 15 basis point range. Now, this should be positive, if anything, because it means that right now there's not a great deal of volatility in the bond space. The key thing is, of course, these elevated yields. Okay, the longer these yields stay up at 435, over the long period of time, you can see, of course, the administration's concerned about this, and they have every right to be. Okay, they're having to refinance themselves at substantially higher yields. So this is the key for the economy. We keep talking about why the US economy is not cracked. Well, it's simple. The interest rates hikes and these higher yields have yet to really feed their way through, simply because everyone's hedged via long-dated mortgages and hedges in terms of corporate financing. So the key takeaway is that if we were to be at these 440 yields 1 year from now or 2 years from now, that will of course eventually start to break the US economy. Okay, you can see the US administration's even concerned about this. They don't want to finance themselves for 10 years at 435. Okay, that's the reality of the situation. And so the key now is for the administration is they're going to have to get inflation down. They're going to have to break the back of inflation before we can get these yields moving lower and sustainably lower. What I mean by sustainably, well, you need to get that purple line moving down. Okay, right now, like I can show you, that purple line has been stuck for 2 years, or for at least 18 months inside a 15 basis point range. Okay. Now for this week, I think what is interesting is that we can see over the course of the last, almost week or two, we've really started to see these yields push a little bit lower, and I think that's got a lot to do with the hard data. We can see a number of hard data points, pointing towards a bit of softening. But what I want to stress ultimately is that this is a big week for yields. Okay, right now yields are contained. They're doing nothing. They've been doing nothing for some period of time because it all comes down to this week. We've of course got the non-farm payrolls on Thursday. Okay, and that's going to be where all eyes are. If that number was to come in weak, I do suspect these yields are going to move themselves very quickly back down towards 4%. We know that a number of investors are just waiting to see a little bit of the softening effect come from the tariffs and of course from a number of other issues going on within the United States. So keep a close eye on that. I think that's the key takeaway. One other point to note on this chart, you can of course see that the low tick made over the course of the last 18 months was when of course the Fed cut 50 basis points in September. Okay, now that should prove to be quite shocking in that yields rallied a good 110 basis points when they cut. So just speaks volumes that if Chairman Powell was to cut prematurely today or perhaps this month in July, the reality is that long yields will go higher, not lower. Okay, and that's the key thing to take away from this, is ultimately that rate cuts will prove to be ineffective until the Fed gets inflation back to 2%. Now with that in mind, having a look at some of the equity markets, what is driving the rally? We of course have bonds doing one thing, we have equities doing another thing, and the equities are very much pricing in the big beautiful bill. Okay, it doesn't matter how you want to argue it, the big beautiful bill is beautiful for stock markets. It's expansionary, it's literally putting money in people's pockets, it's literally giving tax revenue back to corporations. There's absolutely nothing bad about the big beautiful bill for the stock market. Okay, and if anything, it seems as though the deal that the Senate's now going to pass back to the House seems to be even more beautiful because it's removing some of the more stringent parts of the policy that are passed by the House. So the key takeaway is there's nothing standing in the way of this trend. Sure, we're going to have pullback. Sure, ultimately the market will have little mini corrections, but the reality is it's up and away. Now what's driving this? I think this is key. What you've got in front of you is effectively the Mag 7 or the FANGs, and you can see the FANGs are ultimately now back at record highs. You can of course see on the weekly chart it's just green after green after green. Okay, investors are piling into the usual names. The retail market ultimately started this, and now it seems like institutions are going to be forced to chase the rally to the upside. Okay, that is the situation now until further notice. If the eco data holds up, if CPI holds up, if non-farms holds up this week, you don't want to be betting against this trade. It's just going to be one-way traffic for the next couple of months. Okay, the reality is if the hard data doesn't crack, there is no justifiable fundamental technical reason to be short of risk. That is the reality of the situation, and this is only going to get more painful of course as prices move higher. Now what we can see, of course, another stellar week last week. Nvidia up 10% 1 week with very little in terms of fundamental news. Meta up 7.5%, Alphabet 7.25%. These are trillion-dollar companies that are just adding billions of dollars of valuation week by week. Now, is that problematic? Yeah, that's not something you want to see. You want to see this rally broaden out to the likes of some of the smaller tech, some of the smaller economy names. But in reality, the likes of the Russell is not going to rally with an interest rate sitting at 4.33. So that's the key takeaway: is that is this sustainable in the long term? No. Okay, you're not going to see Nvidia rallying 10% every single week. But for now, so long as the data holds up, you just have to get on with it, stuck into it. Otherwise, don't go and fade it. Don't provide liquidity to the market. Okay. Now, moving on, of course, I think Bitcoin is very much in play this week, and that's a result of both the technicals and, of course, what's happening in the general risk, sentiment right now. Equities at record highs. What typically happens is we first see money flow into the good stuff, okay, the Mag 7, and then we start to see overflow. So in other words, then people start to chase the rally in the shit. The meme names, the Bitcoins, the really sort of speculative stuff starts to partake in the rally. And I think that's what we're going to get this week. Okay, I think we're going to, maybe not just this week, but over the next couple of weeks, if, of course, non-farms holds up quite nicely, I do expect you're going to see that overflow move into some of the, the real sort of speculative type stuff. And that includes Bitcoin. I think the Bitcoin chart looks really constructive. We've got a nice flat 20-day moving average. We, of course, can see we're in this sort of, call it what you want, pen and flag, I don't care, it doesn't matter. The point is we've got the series of higher lows, 1, 2, 3, 4, 5. We've got 5 higher lows. The key here is we take out that week, that high made in the middle of June, which comes in around, call it 110k. We take that out, it's off to the races. Okay, nothing's going to stop this market. I wouldn't even be standing there at record highs. I'd just be looking for it to break higher. Okay, so 110,000, that is the key resistance. We close above there on a daily. You just have to join the parade. Don't forget, of course, with the long weekend, it's the kind of thing where people are bored. People have got nothing better to do. They read the newspaper, they read Google, and they just go open up their Robinhood app and go and buy it. So join the party, don't fade the party, get on with it. That's going to be a key opportunity for traders this week. Okay, and then finally, in terms of just the bigger picture of Bitcoin, constructively, we start to get a very similar, but almost similar pattern to what we had going into the election. What I want to just illustrate with this chart, of course, when we look at the moving average, is just to showcase that we are not overbought by any stretch of the imagination. We can see both the 20-day average and the 50-day average are very flat now, and we can of course see that 100-day and 200-day steadily rising back up. So again, it's just a market that's pointing towards higher prices. Okay, I suspect so long as the risk rally holds up, I think Bitcoin is going to be in the newspapers in the next couple of days with prints like Bitcoin rises to record high prices. Okay, so keep an eye on that. I think that's very much a market in play. And then finally, our play of the day, of course, it's back in the S&P. It's quite a favorite of mine. It's when we extend a weekly high with a very big range. So the way to think about this, when you have a very big outsized weekly range, okay, keep in mind we had a relatively large rally last week. We were trading on Sunday night around 59.50s, and we of course closed the week pretty close to the high in record territory. So we had a relatively large range. Now, when you've got these very, very large ranges on a week, it's not to say that they cannot continue, but it is to say that typically on Mondays, we're not going to extend that range. Typically on Mondays, what we're going to try and do is just feel our way around, find out ultimately where those buyers are, where that pocket is. And when they find their liquidity, then fine, they may pivot and move higher. But like I said, this week is very much about range-bound trading. And so what that means is we're going to have to just look for a little bit of consolidation. I expect we get below 62.40. I do expect we're going to trade that 62.30. And then, of course, just moving a little bit lower in towards this VPOC here. It's like a weekly VPOC around that 6200 level. I do expect that'll trade, if not today, perhaps early tomorrow. And what sort of gives me a little bit more confidence around that, if we look at Europe out the doors, it's not exactly flying up the page. Okay, Europe opened, it went bid, it's given it all back, it's slightly down on the day. Okay, so this is the theme for today. Expect two-way trade, don't expect one-way train. But then again, don't be afraid to buy it. Okay, it's very much a market now that is in record territory. People are chasing. It is going to be very difficult to be short this market. So you're really going to have to pick those areas where you do be short. And then, of course, opportunity scope. Okay, we're not looking for 1%, 2% moves to the downside. We're looking for, call it 0.2% moves, perhaps 20, 30 handles to the downside. Okay, that's the key takeaway for today. One thing to point out in terms of this profile is we did have a breakout gap last week, so you can see this is the whole weekly profile. Nice bit of consolidation, low volume area, and then we've got these sort of pockets of volume. Pocket, low volume area, pocket, low volume area, pocket, volume, low. So in other words, we had a very firm auctioning process to the upside last week. Okay, it is a trending market. Of course, trending markets do move sideways, and that's what we expect for today. All right, with that in mind, in terms of this week, like I said, the big data is going to come on Thursday. Yes, we got some manufacturing data and services data out early in the week. We, of course, have a number of central bank speakers. They're all up in Sintra in Portugal this week. So, again, we'll be watching that. Unlikely we're going to get anything new, but we'll be watching it nonetheless. But everything's about Thursday. I think the direction and the trend for markets will be set on Thursday. Should that number come in line? Should it stay strong? Should the solid market, the labor market, remain solid? Of course, there's no reason for the Fed ultimately to be concerned. Should we see a little bit of softening? Well, we know the Fed would be all too happy to begin the process of cutting rates, despite the fact that inflation remains elevated. With that in mind, if there are any other questions, do post them in the Discord channel. Don't forget to like, subscribe, and comment to the channel. Otherwise, thank you. Good luck out there. Go manage that risk. Go make some money.